keep competitors out of the sector, particularly Anglo-American platinum. All of the major mining companies, and it was 3 major mining companies, that's Amplats in red, Implats in green, and Lonmin in blue, were at the start of the democratic era controlled by large multi-sector conglomerates. So JCI controlling Rustenburg platinum mines, which is today Amplats, the largest producer. Gencor, the Africana conglomerate, controlling Impala Platinum prior to its unbundling in 2003. And then Western Platinum, which is today Lonmin, was controlled by the British conglomerate Lonrho. And as you can see here, at the start of the democratic era, where I've got data to 97, these 3 companies controlled more than 90% of South African production. So the incoming ANC government had a policy imperative to break the oligopolistic control of the mining sector and redistribute mineral wealth, but without, importantly, resorting to nationalisation, which it argued would scare away foreign investors. So it went down the relatively market-friendly route of black economic empowerment. Now, this was enacted with the 2002 Minerals and Petroleum Resources Development Act, which nationalised mineral resources, meaning that mining companies had to apply to the state for licenses to mine rather than owning rights as private property. And this license was used as a lever by the state to pressure mining companies to serve a redistributive political agenda. Most importantly, compelling them through the mining charter to achieve 26% ownership by what they called historically disadvantaged South Africans by 2014. Added to this was the use it or lose it principle, meaning mining companies had to make efficient use of their mineral rights or risk having them taken. Now, the hope with this was that it would create a new class of black-owned mining companies and break the traditional control of the white mining houses, but also usher in foreign investors to ensure that the country's platinum resources were used to their full potential. And the sector is now considerably more diverse. So from 4 companies in 1997, by 2013, here you have 12 separate companies producing platinum. And that's represented by the multicoloured strip at the top there. Several more companies are moving towards production. The production from wholly owned mines from the big 3 companies has actually been stagnating, or in more recent years, declining. And while the production from these new coming mines is quite small relatively, when you combine them, it's equivalent to adding a new Lonmin to the market. However, how significant these changes are in terms of adequately addressing historical injustice remains a matter of very heated debate between the mining industry and its critics in government. From the industry perspective, mining companies have gone beyond the mining charter ownership requirements. From government's perspective, though, the results have been unsatisfactory, and that's why we've seen a new draft of the mining charter released this year. Now, I'm going to argue that most of this disagreement relates to ambiguities in the interpretation of the original charter, some important design flaws, and also some very, very unfortunate timing. So, the original mining charter was the child of a commodities boom. It was released in 2004 at a time when there was enormous optimism about the future of the mining industry, but about platinum in particular. In its most common form, the most kind of generic model by which mining companies did BEE deals, then the BEE investors in the company would borrow money to start with from either the mining company or commercial banks. They would then use this borrowed money to purchase a stake in the mining company, and the shares that they then owned would be used as the collateral for the loan, the security for the loan. The expectation was then that dividends from their investment would enable them to pay off the debt. Now, this works very well when the industry is in an upcycle, when the price of the shares is rising and when mining companies are paying dividends. But unfortunately, many of the deals were struck right at the end of the cycle, meaning they paid a lot for the shares took on a lot of debt, but have received very few, if any, dividends to pay down that debt. As a consequence, many of the deals have transferred very little value to BE investors who remain saddled with debt. The most important example being Lonmin's deal with Shanduka Resources and Amplatz's with Latsa. The risk for the mining companies is that if these deals fall apart, if the debtors default, then the mining company potentially loses some of its BE credits. Another problem with the model has been that the way ordinary mining investors tend to make money from their investment in the mining industry is not so much through dividends, but through capital gains. That is, selling the shares once they've appreciated in value. But when BE partners do so, then the mining company again risks losing some of its empowerment credits, and that's been the case, for example, with Impacts this year when the Bafokeng sold half their shares. And so there's been a lot of disagreement between the mining companies, the DMR, and BE investors over this matter, and it's kind of a sad irony of the reforms that there's a mutual dissatisfaction over this. The mining companies have argued that they carried out the deals in the assumption that a once empowered, always empowered principle would apply, that once a legitimate deal was done, then that was the end of the matter. The government, meanwhile, has criticised the use of debt in these deals as not securing meaningful empowerment, and has suggested in its recent draft, that draft charter this year, that companies must re-empower. So rather than settling the matter of historical redress, the distributive pressures from the mining charter have rumbled on, generating new uncertainty for the industry in future and new forms of tension between state and private sector. I'll now move on to the next distributive pressure, that from labour. Now, fundamentally, PGM mining in South Africa developed around a highly labour-intensive business model, which remains the case for most mines today. This was partly a response to geology, the narrow, complex reefs of the Bushveld complex, but it was facilitated by the supply of cheap black labour. The ability to control wage increases, high levels of discipline through the hostile and migrant labour system, and lower safety standards than would be considered acceptable today. And this business model has not proved compatible with the democratic era, and as a result, conventional mines face quite an uncertain future. The key trend over the long term is that costs of production and employment in the industry has been rising, but without corresponding productivity increases. So here, in the blue line, you have the numbers of employees in the industry pushing towards 200,000, but the amount of PGMs per employee falling from the start of the new millennium. And in this chart, I've got platinum production, or PGM production in the blue bars, and then the labour cost per PGM ounce rising. So essentially, as I say, the mining companies have lost this ability to control labour costs, which was the basis historically of their business model. Right. Albeit beneath this, there are considerable inequalities, particularly relating to contract labourers who earn about 60% of what full-time employees do and make up about a quarter of the workforce. But on average, employees in the platinum sector earn about 16,000 rands a year, per month, sorry, in 2014, which is about double the national average. Okay, so these productivity trends, it's a result of a combination of factors, the most important of which is organised labour's successes in pushing for higher wages. And this is not surprising, since labour-intensive mines are inherently very vulnerable to strikes. But there's a lot more to it than that. Firstly, mines have been getting a lot deeper, so travel times to the mine face have increased. Second, the move to workers living out has imposed, rather than in the hostels, has imposed a lot of new costs, particularly as living conditions in the informal settlements around the mines in Rustenburg remain very squalid and difficult. Third, the ores mined have become less PGM rich. Thanks. And fourth, the the companies have significantly improved their safety, but this has meant adding new non-production employees and introducing new overhead costs. The DMR has also begun regularly closing down mine shafts when it sees safety breaches, and this again has disrupted production. Finally, it's important to add that the whole cost base has been undergoing inflation, not just labour costs. Input costs like electricity in particular have been going up at an even higher rate. There are more besides, but not enough time. The point is, it's not simply a labour issue, but nonetheless wages are the most important item in the platinum mining cost base. They're about 60 to 55% of costs on a conventional mine, so even small wage increases have a big impact. Now, as I said, these are long-term trends, and they've been recognised in the industry to varying degrees since the 1990s. So the question is, why wasn't there a quicker adaptation by the industry to these trends? And the lack of adaptation reflects the fact that inflationary pressures were buried beneath soaring platinum prices in the 2000s. And this made the companies very profitable and entrenched a kind of path dependency on this conventional labour-intensive business model. So what I've got here is the gross profit margins going back to the 1970s for AMPLATs and IMPLATs, and you can see a huge spike in profit margins in the early 2000s, a slightly smaller rise in profits around 2008, 2007 as prices boom but costs are rising, and then over recent years as prices have fallen and costs have carried on rising, the margins have been squashed. So basically during these periods of boom, the mines were producing enough cash to mean that they could fund wage increases, generous dividends for shareholders, and large capital expenditure outlays. The dissatisfaction with the industry from investors generally related to their inability to deliver on goals for capacity expansion. So companies threw a lot of money at this during the boom. As revenues declined after 2009, cost cutting became the priority, and this led to increased tension around wage increases and is a factor in why wage negotiations have been so fractious over recent years. So the final new pressure of the post-apartheid period relates to financialisation, which, as I said, in the definition that I use at least, is the increased sway of capital market demands over company management to deliver shareholder value. Now, as with labour and government and mining communities, this is a story about increased distributional pressure on the company management emanating from raised expectations, but it's from a very different source and for very different purposes. The period of political liberation in South Africa was also a period of economic liberalisation, and as capital controls were loosened in the 1990s and the platinum miners were unbundled from their parent conglomerates, they became embedded within increasingly internationalised capital markets. And as such, they've become subject to intensified demands to deliver shareholder value, because the increased mobility of capital, its ability to move to other destinations around the globe, brings increased expectations for returns, since investors are better able to redirect their money to higher yielding opportunities worldwide. And this is hardwired into management by the use of share-based incentive schemes, for example. Capital markets over the last 20 years globally have also become increasingly impatient. The average duration of shareholding periods, that is the average time investors hold on to their shares in the United States, has dropped from 7 years in the mid-1970s to 7 months by 2007. And this is also a trend which affected the PGM industry. So AMPLATs in the early 1990s had an average shareholding period of 4 years, but by the mid-2000s this had fallen to less than 1 year. Investments also now increasingly mediated by fund managers who are commonly incentivized on a quarterly basis and therefore themselves pressured to seek short-term returns from the companies. Now this is true for all enterprises, but it creates quite tricky problems in mining because of the mismatch of investment time horizons. Mining companies are commonly investing in projects, new mines which take 10 years to bring into production and have a lifespan of decades and a social impact of decades, whereas investors are commonly geared to a view of around 3 months to 3 years. So it's a very difficult mismatch to manage. But the platinum mining companies were, for a short time, very successful at delivering shareholder value before becoming very unsuccessful over the last 8 years. So what the chart shows here is the economic value added achieved by the 5 largest platinum mining companies. That is the return on invested capital minus the cost of capital, the cost expected to return to equity investors and to service debt. So when it's a positive value, it shows they're earning ahead of that and shareholders are doing very well. When it's below, the opposite. So you can see here, well above it for most of the 2000s, but since 2009, well below. And consequently, when you look at the platinum mining company shares here, they went from massively outperforming the JSE Top 40 Index, the black line, and the JSE Mining Index, the dotted line. Huge overperformance, particularly for AMPATs, to crashing well below it over the last few years. So it's been a pretty spectacular boom and bust in the platinum sector. Now, when looked at over the very long term, this is somewhat in the nature of speculative mining investment. Investors typically in mining endure low returns for long periods, for short periods where they get spectacularly rewarded. So long winters and short summers, as the Chamber of Mines likes to say. But the 2000 to 2008 period was a particularly long and hot summer, and many people believed that it wasn't going to come to an end anytime soon. The narrative of the time was that we were in a commodities supercycle, not just a normal cycle, a supercycle that was being driven by China's urbanization and industrialization, that essentially we could be confident that prices for metals, but PGMs in particular, would stay stronger for longer. And company management, therefore, came under incredible pressure from shareholders to use the huge amounts of cash it was accruing in this period, either through the pursuit of expansion projects, or through the purchase of competitors, smaller mining companies, or through increased returns to shareholders through dividends. Companies were also pressured to become less conservative than they had done in the past as regards to taking on debt. And the companies responded to these pressures. Dividends increased in size, particularly Anglo-American Platinum. Money was thrown into expansion projects or the purchase of smaller companies, and cash drained from the companies ahead of the slump. So this is not to criticize the companies for inability to see the future, since the supercycle narrative was kind of common sense at the time, but rather it contextualizes the distributive pressures, the intense distributive pressures which led to these actions. So now I'll move on to the concluding section. The pressure now upon management is to try and restore. How long have I got? Okay. All right, yeah, I'm just in the conclusion now. So the pressure now on management from shareholders is to try and restore an acceptable return on capital, to try and get the share price up again. Part of the way they're doing this is by trying to dramatically cut back on their costs, cut back on their capital expenditure, and this is part of the reason why wage negotiations have been particularly fractious. It also might set the stage for the next upturn in the commodities cycle for PGMs in years to come if there's dramatically reduced supply. But attempts to secure higher returns are also leading to a pressure to shift away from the older, deeper, labour-intensive mines around Rustenburg to shallower and more easily mechanizable deposits. And this is likely to change the geography of platinum mining away from the old centre of the industry in Rustenburg towards the eastern limbs of the Bushveld complex in Limpopo and Mpumalanga, and to the Great Dyke in Zimbabwe. And this chart illustrates why. What I've got here is tons milled, so tons of ore milled per employee. And I've got 4 mines from Anglo-American Platinum, 2010 to 2013 in red and 2007 to 2010 in green. At the top there's the Mogalakwena mine, up on the northern limb, which is the subject of the 3rd swap working paper of the series, where workers are producing around 5,000 tonnes per employee. The Motolo mine on the eastern limb, which is a mechanised board and pillar method mine, producing over 1,000. And then at the bottom, the Union mine and the Rustenburg mine, the older traditional labour-intensive mines, which Amplatz is currently trying to sell, which are around 500 or less per employee. So this demonstrates what Amplatz are trying to do, is to move away from that and move to that. And this business model, Mogalakwena and Motolo uses considerably less labour. The labour it does use is, to a greater extent, highly skilled and highly paid. And also, I think, an important consideration for management, it's less inclined to join AMCU. And those on the right side of this transformation in the industry are cheerily optimistic about the future, about an end to kind of labour conflict and the social problems associated with Rustenburg. So this is the chief executive of Ivanhoe Mines, which is also building a new mine on the northern limb near Mogalakwena. He's saying everyone working at the Platreef mine will be in an air-conditioned cab, there will be no exploitation of human labour. It's the kind of mine operation where there will be no fatalities or injuries. The men and women who work here will be very well paid, professionals who will lift nothing heavier than a pencil. And what I'd, yeah, so a bit like an academic apart from the well-paid bit. But what I'd like to say though is that the realities may turn out to be somewhat messier for society at large through this shift. I mean, firstly, Lonmin and Amplatz remain dependent on their Rustenburg operations, which are very difficult to re-engineer towards mechanised methods because the reefs there are so narrow. Lonmin tried to do this in the mid-2000s and it was an absolute disaster. If the price of PGMs don't rise and greater cost reductions are not secured, the future of these mines is quite uncertain. Lonmin nearly went into business rescue in October last year, but was bailed out by the PIC. The difficulty is notwithstanding its multiple well-documented ills, the labour-intensive business model of traditional platinum mining creates mass employment, supporting hundreds of thousands of workers and their dependents. It's estimated that platinum miners there have an average of about 10 dependents. And in this model, the mine and the adjacent community are locked in a kind of complex interdependency. Put simply, the more mechanised mines that represent, in many eyes, the future of the industry cannot provide direct mass employment. Now, there are aspirations that a shift to mechanised mining could create new job opportunities in the domestic manufacture of equipment for mechanised mining, but this will require a kind of coordinated industrial state intervention, which we're yet to see up to today. Meanwhile, in the case of Mogalakwena, as the working paper to be presented by Farai later this year will show, communities are still subject to various forms of disruption to livelihoods and environmental harm that come with mining, particularly as it's an open cast operation. Now, at face value, this moves platinum mining closer to the classical enclave model of mining. And since the mine is not able to generate mass employment, the redistributive mechanism and the redistributive tensions around the mine become not the wages of the workers, but forms of quasi-voluntary social responsibility, corporate social responsibility, and community engagement and empowerment. And with this, the focus of redistributive pressures in the industry and the kind of point of tension between the industry and wider society shifts from the workforce to the community, with all the difficulties that come along with working out who this community includes and excludes. And I think that kind of forms the basis or provides the context for the working paper which Stanley Malindi is going to present next, and Farai later on in the year. Thanks very much.
Thanks very much, Andrew. So we're going to have to run a little bit tight today because we started late, but we still have 45 minutes for questions and for discussion. Can we see if we could begin just actually with any questions of clarification, to be kept fairly short? Is there anything in particular that Andrew's presented which you didn't quite get or you'd like him to go over again? And then we can move into a more detailed discussion. If you could put up your hand, please, and also when you speak, tell us who you are and where you're from. And Stanley will bring you the microphone. So, any initial questions, points of clarification? No. Okay. So, 1 and 2.
Thank you very much, for the insightful presentation. It's David from States. But my question is, I just wanted to link up with the current rumors of our local vibrancy. We heard the CEO are sleeping out. So that reminded me as well, was the mine workers were sleeping out as well before them in the copies. This is history. So but about the future. So now you see the issues. I was keen to find out, can you see or foresee a possibility maybe as well? Could we possibly have a mining minimum wage or miners minimum wage in the long run or something like that and stuff?
Okay. Thanks. So we'll take 3 after so.
Yes, thanks again. My name is Vuyo Vuyo from the National Union of Metal Workers of Kalumso. I think I've got about 2 questions. And the first one is, you spoke about political liberation, followed by economic liberalization. What do you mean by political liberation in South Africa? Because I believe there's none of the sort. We haven't got into that particular point. So I need some lecture. The second one is, you haven't said anything about the role of trade unions in the whole development and the challenges, the difficulties confronted by workers and the platinum mine owners. I think I have those two areas.
Thanks. And any other just and one more at the back?
Ms. Francis from Languages. Mine is a short one. It'd be interesting to see how much was the profit from the mines during the boom and the profit from the mines during the past. Do you have any figures there? And then the question of, during the strikes, most of the time you will hear if mine workers want a certain amount of money, they will be told by the mining company that we cannot pay so much. But in the meantime, they will go to the media and say we are losing 100 million per day in production. What does that mean? Because I never understand. If you are making 100 million a day, and these guys, they want 12,000 or 10,000 a month, that really doesn't make much sense.
Thanks. So
Okay, sure. So the question about the minimum wage. Well, this is an interesting one because obviously there's discussions going on at national level in government over the introduction of a minimum wage now. I think for platinum mining, this is not something that companies are particularly worried about because the entry-level wage in platinum mining is so far above what would be, what the kind of figures are that might be introduced as minimum wage. So the minimum wage seems likely to come in at around somewhere between 3,000 and like maybe 4,500 rands per month. Whereas in PGM mining, the entry-level wage is 8,000 rands plus about 4,000 rands benefits. So PGM miners are already coming in well above the level of what would be the national minimum wage if one is introduced. I mean, that said, as I mentioned, things become a lot murkier when you think about contract labour, which is still used very extensively, but is very hard to get data on that. So the question, political liberation, yeah, I mean the end of apartheid. I guess whether that's considered political liberation or unfinished business is a matter of debate. But yeah, I mean the collapse of the apartheid government and the ascendancy of the ANC. As regards trade unions, well, I mean, when the section on labour, I mean, what I meant there is, I mean, these are the results of organised labour successfully pushing for higher wages over the last couple of decades. So, I mean, really, I was trying to frame that whole section around organised labour. And I mean, it's something I write a bit more about in the working paper, but I've not spoken too much about the politics of trade unions in all this. Partly because it's been written about quite a lot by other academics. I mean, particularly Crispin over there has written a lot of good stuff on the politics of trade unions in the platinum mining industry. So I didn't feel that there was a need for me to replicate that excellent work, if you know what I mean. My focus was on the companies themselves rather than trade unionism. So the question about profits. I mean, in terms of profitability, I mean, the gross profit margin is a fairly good indicator, which you can see drops down from peaks in the 2000s to very low levels in more recent years. But in terms of profits accrued, I mean, there's more information, I guess, in the working paper where I look at how the profits were distributed between different parties, what went to shareholders, what went into capital expenditure, what went to the government as taxes. But yeah, since I only had 25 minutes, then and then your question about 100 million rands per day losses. You were saying that what does it mean when the mine bosses are saying we're losing 100 million rands a day? Okay, well, as I mentioned, as kind of prices in the PGM sector have crashed over recent years, then it's meant that a lot of the more expensive mines, the mines that have higher costs of production, have gone into loss-making territory. And what adds to this is that it also takes a lot of capital expenditure. So that's expenditure on sustaining and expanding the mine to keep the mine in business. So it means that companies have a lot of ongoing costs, and particularly for the older, deeper, less efficient mines like Lonmin's Marikana or Amplatz's Rustenburg mine, it's meant that at certain times they have been loss-making.
Great, thanks for that. If I could just add something there to you on labour. Absolutely right to raise the question of labour. What we're doing across SWAP's work is obviously we're chopping it up a little bit. So we've had a whole batch of work which has looked at the questions of mine labour. This was focusing on capital, but of course capital can't be understood outside of its relation with labour. You're absolutely right. But for more of our work specifically on labour, I'll just refer you now to this special issue of a journal, an academic journal, called the Review of African Political Economy, which many of you will know. We brought out this special issue at the end of 2015, and it brings together a lot of swaps work actually on mine labour, and labour not just at the point of production, but also questions of the reconfiguration of the migrant labour system, the questions that raises about the social reproduction of labour, which is also then about mining communities, it's about gender, and so forth, and of course worker organisation, trade unionism and struggle, so those are covered more there. Anyway, we can take on 3 more questions, so great, so I see 1, and in fact if we go this order, we'll go 1, we'll go 2, and then, is there a third? Let's take the 2 for now, and please remember to say who you are and which organisation you're with.
Hi, Develop Chaban from Chamber of Mines. Thanks for the presentation. Just 2 questions from my side. I'm intrigued about the slow adaptation to changing circumstances. You basically say, well, I guess it was kind of like hidden by the high profit margins, but have you delved into it a little bit more to consider, you know, the structural nature of the platinum sector, regulatory issues and the like? I mean, why would it be so difficult to make those changes? I'd just like you to elaborate on that. And then just secondly, on the financialization component, this short-termism is certainly concerning, especially I think in a sector that's got to be, that is into long-term planning, and it takes a while before you make any money. Is there any reprieve, is there any change in terms of the investment community trying to maybe be a little bit more conscientious and looking at it more of a long-term view? I mean, are we seeing this, any change at all, or is it just getting worse?
Thanks very much. My name is Theron Douglas from the School of Physics. I wanted to know more about the issue. I know we talk about legislation changes and with the DMR and the changing of those legislation, but there was also another issue was very critical in that ANC conference in 2012 in Mangawu of proposing about the issues of super tax, which nobody knows what was there to really clarify about how much tax was for this. But also I was looking at the issue whether is there a possibility in the future that we could own 51% of these mines like in the neighboring countries. But the last issue I think which is also more complex is the issues about those communities. Who must really benefit? Is the community around or is the neighboring communities? I know there's also issues about these communities and their income and the beneficiaries. Thanks.
Thank you. Thanks. Are there any others before Andrew responds? Going.
Okay, so the issue around slow adaptation, I mean, yeah, as I said, they're making so much money in this period that there wasn't such a pressing need to try and change the model of production. You know, they carried on sinking investment into conventional mining, but part of the reason is also technical problems, which I go into in a bit more detail in the working paper. So, I mean, in PGM mining, the companies have been experimenting with mechanized production methods for the narrow reef mines since the late 1980s, using the trackless mining vehicles, the ultra-low profile vehicles. And basically it had always proved a very tough nut to crack because the reef's so narrow, the reef undulates and breaks a lot. And so, I mean, essentially, human labor just proved to be more efficient than the machines for this particular geological environment. And that's kind of what lay behind the big disaster at Lonmin in the mid-2000s when it tried to mechanize this environment. I mean, there's also, I think, it's important to, again, go back to the shareholder pressures, as in, when you try and re-engineer a mine for mechanization, there's going to be a lot of upfront costs in equipment, in re-engineering the mine, And it's quite a risky thing to do, and shareholders will be reluctant for those kind of gambles to be taken. So there's huge difficulties changing these labour-intensive mines to new methods. So I hope that answers that question. Short-termism, and is there a kind of reprieve? Well, it's quite interesting. I think because it doesn't look like the industry is going to start paying dividends again in the near future, I think from what I'm hearing, and a lot of the people that are buying the shares now are kind of short-term value investors, so they're looking for the share price to rise and then make a capital gain. But I mean, perhaps more interesting is the increased role of the PIC in the industry. So, as I mentioned, it kind of propped up Lonmin last year when it stepped in to support its rights issue in October. And now it's the single largest shareholder in Lonmin with about 1/3 of the company. And this possibly points to something quite interesting if state institutions are going to start playing a larger role as potentially more patient, supportive investors for an industry that's struggling. And it perhaps also raises interesting questions around empowerment, because obviously state ownership was, or partial state ownership was rejected as an option previously, but now it seems to be happening by accident almost. So no, I don't see any reason for a reprieve from the investment community as a whole, because they're still, the investment community, when we talk about that, as I say, I mean fund managers are incentivized to be short-termist. Capital is very mobile, so I don't see any change to that, but the increased role of the PIC could mean something quite interesting, perhaps. So the next questions. So the issue of the super tax, the resource rent tax that was part of the ANC's SIMS document back in 2012. This is quite an interesting and complicated issue. So for those who hadn't heard of it, the idea, the suggestion was to have a form of profit-based tax, which during periods when the mining industry went through spectacular profitability, like the kind of 2007-8 boom, then the state would be able to take a larger share of that profit than under using normal corporate tax. This has been rejected by the government and by the Davis Tax Committee last year. And the reason is that they say that the royalty system, which was introduced in 2010, does the same thing, that essentially there's no need to have a super tax because of the royalty. Yeah, I think for myself I'm kind of undecided on the matter, but there was some interesting research done by the IMF for the Davis Tax Committee, which actually showed that if in hypothetical scenarios they modelled a super tax, a resource rent tax would actually be quite effective at getting a larger share for the state. And I think it's an important debate to have, because over the platinum industry is in a bad slump, but it's quite foreseeable that the industry downsizes, restructures, and could possibly go through another boom again in the future. And it's important that those kind of debates happen now, because unfortunately when you look at mining legislation, there's a tendency to kind of introduce legislation that's good for a boom, usually when it's coming to an end, which is what happened with the royalty. Okay, the 51%, I guess are you referring to like Zimbabwe? I myself don't foresee the ANC going for that. I don't foresee them being that radical. They're trying to make the mining charter more rigorous by requiring, you know, in the latest draft, requiring companies to re-empower to 26%. But I've heard no indications that they'd go to 51%. And I think the reason being is that they'd be worried about what this would mean for foreign investors. So that's I wouldn't expect to see it. Communities. This is a very important issue, and I guess it's why the next SWOT working papers do such a lot around communities. I mean, communities as a BE partner have got a lot of advantages for the mining companies. First of all, when there have been all these problems with BE investors, traditional BE entrepreneurs, selling their stakes in the mining companies, then there's an expectation that communities, as they're bound to the mine, are less likely to exit, that you'll have a more long-term empowerment partner. That's one thing. I mean, the other thing is that communities also help stabilize the environment around the mine, hypothetically. As in, mines have faced a lot of protest, and there's an expectation that they align their interests with the community. But it's turned out to be a very messy process, because there are big issues around transparency and accountability with a lot of the tribal authorities that have been pulled into BE deals, and there's always huge conflicts, well, not always, but often huge conflicts around who the community includes and excludes, who makes decisions, where the money goes, and there's not really a standardized model for how this is managed, and I think that's really what's kind of needed for the industry going forward now, is a kind of a standardized model by which communities that are brought into empowerment deals, you can ensure that there's transparency and accountability.
Great, thanks Andrew. Any final questions or comments? Yeah, so we got one at the back. Others. Okay, let's start there.
Just one question. Regarding the future, is it promising? Is the industry promising? Is there any future? Do you see ladder at the end of the tunnel, or there's no tunnel at all?
Okay, is there light at the end of the mine shaft? Any others? Yeah, Karen. And please remember to say who you are and where you're from.
I'm Karen Campalis from the Crisani Institute. My question is a little bit outside the remit of your presentation, which I found very interesting, by the way, thank you. But I'm trying to understand the sort of underlying situation here. And you started your presentation by saying that the slump after 2008 was due mainly to two factors, falling prices and increased cost of production. So it's the falling prices bit that I'm trying to understand. Platinum, as I understand it, became very popular because of the rise of catalytic converters in vehicles. So vehicles are still using catalytic converters. And you did talk about recycling, which I suppose accounts for part of the reduced demand for freshly mined PMGs. But I don't know that it would account for all of that. So I'm just trying to understand why the demand has fallen, because falling demand must be one of the reasons for falling prices.
Okay, sure. All right, then. So maybe I'll start off by answering two of those together, because I guess the light at the end of the tunnel, largely depends on what's going to happen to the price. I mean, I just first of all go back to this slide here. This is where the price has gone in actual terms, the green line down, and this is where investment bank analysts who are, their living is to forecast prices. This is where they expected it to go. So, I mean, it's a very interesting thing that kind of nobody understands that well at the moment how the market is working. And I've spoken to quite a lot of people around this. I mean, the major issue at the moment is the extent of above ground stocks of platinum. So what happened essentially was in 2008, the mining companies were gearing up for increased production, and then suddenly demand fell off a cliff. All the automakers were suddenly not buying the metal, not using the metal, but they continued to buy it. So there was a big overproduction of the metal which went out into the world and is now sitting around in stockpiles in various places, but nobody knows quite how much are in these stockpiles. I've heard estimates. Some people say there's about 2 million ounces. Some people say there's 9 million ounces. And these could be, some of them are in Swiss bank vaults. Some of them are in warehouses used by like the New York Metal Exchange. Some of them are in manufacturers' stockpiles. And there's no clear way that many people claim it, but there's a huge amount of disagreement about how much stuff there is out there. And essentially what happens is as the price rises, people can sell this stock onto the spot market. So it's this problem of overproduction and above ground stocks of the metal which have been a big problem with the price. And so, I mean, looking at the future, a lot of the debate revolves around when these stocks are going to be exhausted and when the kind of normal supply and demand dynamics are going to kick in again and we might start getting a rise in the price. And this also relates to kind of the cutbacks that are going on now. So part of the response to the slump, as I say, is that shareholders have been telling the companies, preserve cash, preserve cash. So they've cut back on their capital expenditure. They're trying to close unprofitable shafts, and this means that if in a few years then the above ground stocks are exhausted and demand for the metal increases, demand for the mine supply increases, there could be another spike in the price. So I think a lot of the future relates to that. And this also, your question about light at the end of the tunnel, I mean, I think as I said in the presentation, the situation for the big labour-intensive mines in Rustenburg is pretty uncertain. Because if there's not a substantial increase in the price, if they don't start making more cash, then they might simply mine those things out and not invest in new production. So they might just be, mined out over the next 10 years, and that's the end of some of those mines. And I mean, that's a worst case scenario, obviously, but the social implications of that would be pretty huge because you've got such an enormous community around those Rustenburg mines, directly employed, many tens of thousands of people and many tens of thousands more dependent on it. So if it was to happen, that those older labour-intensive mines shut down, I mean, it would be an enormous social challenge for government to deal with the consequences of that.
Okay, thanks, Andrew. Well, I think we could probably leave it there, unless there are any burning questions or comments. No? Okay, Andrew, so first of all, thanks very much for an excellent presentation. With much more besides in the working papers. The copies of the working paper are available at the back. If you're from a large organisation or institution like NUMSA or like them, and you would like to order multiple copies, then please speak with me and we can see what we can do. Copies will also be available from the Swap Administrative Office.